Imagine a company announcing this to its shareholders. Revenue has increased slightly, but management has decided to lock most available capital into long-term illiquid commitments. Cash buffers will be thinner, flexibility will be reduced, risk exposure will be higher if conditions change. The justification is not return on capital, but effort. Management insists that if the team just works harder, the balance sheet strain will resolve itself. No serious analyst would accept that explanation. Yet this is effectively how many individual financial lives are structured, not because of laziness, lack of discipline, or insufficient ambition, but because culturally celebrated decisions are rarely examined as capital allocation choices. They are framed as moral achievements rather than balance sheet moves, and that framing obscures risk. When people say they can't get ahead, the assumption is usually behavioral: not enough hustle, not enough sacrifice, not enough motivation. But from a systems perspective, stagnation often emerges even when effort is high. In corporate finance, this would immediately raise questions about structure rather than character. Effort matters, but effort deployed into a fragile system compounds risk instead of reducing it. At the personal level, income is revenue. Savings are retained earnings. Debt and fixed obligations are liabilities. Time and health are non-renewable assets. Progress depends less on how hard each input is pushed and more on whether the system can absorb shocks without forcing suboptimal decisions. A household that operates with minimal liquidity and high fixed costs is structurally fragile, regardless of how diligent the people inside it are. This is uncomfortable because it reframes widely praised life choices as financial commitments with trade-offs. Stable employment, home ownership, credential accumulation, even lifestyle upgrades. All of these can be rational decisions. They also consume capital, reduce optionality, and increase dependency on uninterrupted income. The issue is not the decision itself, but whether its risks are understood and priced in. Yes, these choices provide real benefits. Stability reduces stress. Predictability enables planning. Long-term commitments can compound value over time. Those benefits, however, do not eliminate liquidity risk or timing risk. They merely postpone when those risks become visible. Consider opportunity cost. Capital allocated to fixed obligations cannot be redeployed when conditions shift. In corporate finance, overinvestment in long-duration projects during uncertain cycles is treated cautiously, not praised as commitment. Individuals, by contrast, are often encouraged to fully deploy their financial capacity early, leaving little margin for error. This margin matters because income is probabilistic, not guaranteed. Even in stable professions, earnings fluctuate. Illness, layoffs, industry shifts, family obligations, none of these require catastrophe to materially alter cash flow. They only require bad timing. The result is not failure, but forced decisions: selling assets under pressure, accepting unfavorable work, delaying recovery. From the outside, it can look like stagnation. From the inside, it feels like running in place. Once liquidity tightens, human behavior begins to matter more than spreadsheets. This is where many analyses stop too early. In theory, long-term plans smooth volatility. In practice, people are loss-averse, stress-sensitive, and operating with incomplete information. When buffers are thin, decisions are no longer optimized for return, they're optimized for survival. This is not a moral failure, it is a predictable behavioral response to constraint. In corporate finance, we explicitly model this. A firm with high leverage may have positive expected returns, but higher probability of distress-driven actions, asset sales at poor prices, underinvestment in growth, or excessive risk-taking to recover losses. Individuals behave similarly. When fixed costs consume most monthly cash flow, even a modest disruption can cascade. The person may avoid switching jobs even if it offers better long-term prospects because the short-term risk is intolerable.
They may postpone skill investment because time-off income feels unsafe. They may rely on expensive credit because there is no slack. None of this is laziness. It is the second-order effect of low optionality. This is why two people with similar incomes and similar effort can diverge so dramatically. One system has slack, the other does not. Slack absorbs volatility quietly. Fragility amplifies it. There is a counterargument worth addressing. Structure can also create discipline. Fixed commitments can force saving behavior, reduce frivolous spending, and align actions with long-term goals. This is true. In some cases, illiquidity acts as a commitment device. However, discipline achieved through rigidity comes with a cost. If the external environment changes faster than the structure can adapt, discipline turns into constraint. Another counterpoint is that risk is unavoidable. Holding back capital in anticipation of uncertainty can mean missed growth. Also true. Cash has an opportunity cost. Excessive caution can be its own form of underperformance. The issue, again, is not the presence of risk, but whether risk is concentrated or diversified across time and outcomes. To see how this plays out, consider a realistic, non-dramatic scenario. A mid-career professional earns a solid income. Most cash flow is allocated: housing, transportation, insurance, family obligations. Savings exist, but they are largely locked into retirement accounts or long-term assets. A restructuring occurs at work, not a layoff, but a role change that reduces variable compensation for a year. Income drops by 20 to 30%, within a normal range of outcomes. On paper, the household is solvent. Over a 30-year horizon, the plan still works. In reality, monthly liquidity tightens immediately. Choices narrow. The professional delays switching to a more resilient role because retraining would temporarily reduce income further. They defer maintenance, health spending, or career investment. Stress increases. None of these actions show up as a single catastrophic event, but over several years, they compound into slower progress. From the outside, it looks like someone who plateaued. From a systems perspective, it is someone whose financial architecture converted a moderate shock into long-term drag. This is where socially celebrated decisions deserve re-examination, not to criticize them, but to place them on a balance sheet. Long-term commitments increase exposure to timing risk. They assume income continuity and stable conditions. When those assumptions hold, the structure works. When they do not, the cost is paid in flexibility. Importantly, this framework also explains when these decisions can work well. High fixed commitments paired with high liquidity, diversified income streams, or strong downside protection reduce fragility. A household with 6 to 12 months of accessible reserves, insurance that actually covers disruption, and skills that transfer across roles faces the same obligations with materially less risk. The decision did not change, the structure did. The common narrative says progress is blocked by insufficient effort. The quieter reality is that many people are operating inside systems that penalize variance. In such systems, average outcomes can still be achieved, but outperformance is rare because deviation is dangerous. Understanding this does not require rejecting ambition, stability, or long-term planning. It requires recognizing that resilience is not a personality trait, it is a design choice. Once you see progress as an outcome of system design rather than personal virtue, another layer becomes visible: path dependence. Early financial structures constrain later choices in ways that are difficult to reverse, even when income rises.
In corporate terms, this is known as capital lock-in. A firm that commits too much too early to a specific strategy may grow, but it becomes less adaptable. Pivoting later is costly, not because management lacks intelligence, but because previous decisions narrowed the feasible set of options. Individuals experience the same dynamic. As fixed obligations scale with income, lifestyle becomes embedded. Expenses that were once discretionary become non-negotiable. The system adapts to consume available capacity. This is why higher income does not reliably translate into greater freedom. In some cases, it increases exposure. More revenue allows for larger commitments, which in turn require more revenue to sustain. The balance sheet expands, but so does fragility. From the inside, it feels like running faster to stay in place. Human behavior reinforces this. People anchor their identity and self-assessment to past decisions. Reversing or downsizing a celebrated choice can feel like admitting error, even when circumstances change. This creates inertia. In finance, we would call this escalation of commitment. In personal life, it is often mislabeled as perseverance. Again, there is a legitimate counterpoint. Consistency and persistence do produce compounding benefits. Career capital, reputational trust, and long-term investments often require staying the course. Abrupt reversals can destroy value. The mistake is assuming that persistence and rigidity are the same thing. One preserves optionality, the other consumes it. Second-order effects matter here. When a system discourages deviation, it also discourages experimentation. Small, low-risk bets, new skills, side income, geographic flexibility are postponed because short-term volatility feels unaffordable. Over time, the individual becomes more dependent on a single income stream and a single set of assumptions. Risk concentrates quietly. At this stage, many people internalize the outcome. They conclude they are behind because they made the wrong choices or didn't push hard enough. But from an analytical standpoint, what failed was not effort, but stress testing. The system was never evaluated under adverse but plausible scenarios. Stress testing is standard in finance for a reason. It forces decision makers to ask not whether a plan works on average, but what happens when reality deviates from expectations. Most personal plans are evaluated only under best guess projections. Rarely are they examined under income interruptions, delayed promotions, health constraints, or shifting industries. When those deviations occur, the cost is not just financial, it is strategic. This is why advice that focuses solely on motivation or discipline often misses the point. It treats outcomes as linear functions of effort, when in reality they are nonlinear functions of structure interacting with uncertainty. You can increase input and still see diminishing or negative returns if the system is brittle. Seen this way, not getting ahead is less a failure to climb and more a failure to build slack into the ladder.
At this point, it becomes clear why the standard narratives are so persistent. They are simple, emotionally satisfying, and difficult to falsify. If progress stalls, effort can always be prescribed as the missing variable. Structural explanations are less convenient because they imply trade-offs rather than virtues. But finance is built on trade-offs. Every allocation has a cost, even when the benefits are real. Liquidity, for example, is often dismissed as unproductive. Cash does not compound like invested capital. Holding it feels inefficient. That assessment is partially correct and incomplete. Liquidity is not primarily a return-generating asset. It is a risk management instrument. Its value appears when other assets or income streams are impaired. In those moments, liquidity converts uncertainty into time, and time preserves choice. Without that buffer, the cost of capital rises sharply. People accept worse terms, higher interest debt, unfavorable work conditions, rushed decisions, not because they misjudge value, but because they lack alternatives. In markets, this is known as being a price taker. Progress slows not due to lack of intelligence or diligence, but because the system has no bargaining power. Opportunity cost operates in both directions. Capital tied up in fixed obligations cannot be redeployed. Capital held too conservatively may miss growth. The optimal balance depends on volatility, income stability, and personal risk tolerance. None of these are static. Treating any configuration as universally superior is analytically weak. This also explains why advice that worked for one cohort or economic regime does not generalize cleanly to another. Lower volatility environments reward leverage and long-term commitments. Higher volatility environments reward flexibility and redundancy. Individuals operating under outdated assumptions can appear to struggle despite doing everything right. Importantly, this is not an argument against long-term investment, ownership, or commitment. It is an argument against ignoring distribution of outcomes. Average returns matter less than worst-case survivability when forced decisions have permanent consequences. When systems are resilient, effort compounds. When systems are fragile, effort merely sustains. That distinction is subtle but decisive. The real reason many people feel stuck is not because they lack discipline, but because their financial architecture is optimized for a narrow range of outcomes. It performs well when conditions align and poorly when they do not. Over time, that asymmetry dominates. A more useful way to think about progress is not in terms of hustle or sacrifice, but in terms of exposure. What risks are being taken, which ones are being compensated, and which ones are being assumed for free? What assumptions must hold for the plan to work, and how sensitive is the outcome to their failure?
These are not motivational questions, they're analytical ones. They do not produce universal answers, only clearer trade-offs. In the end, getting ahead is less about pushing harder and more about whether your system converts uncertainty into opportunity or into constraint. The difference lies not in effort, but in how the balance sheet absorbs reality. A useful lens, then, is to evaluate personal decisions the way an analyst would evaluate a firm facing uncertainty, not by asking whether the choice is admirable, conventional, or well-intentioned, but by asking what it does to resilience. Start with exposure. Which outcomes materially impair the system, and how likely are they within a reasonable range of scenarios? Income continuity is rarely binary. It degrades. Expenses, however, are often fixed. That mismatch creates convex risk. Small deviations produce disproportionate consequences. A structure that tolerates only a narrow band of outcomes is not fragile because it is poorly managed, but because it is tightly optimized. Next, examine liquidity in functional terms. How much time does the system buy if revenue is disrupted? Time is not just a cushion for consumption, it is a buffer for decision quality. It allows for search, renegotiation, and recalibration. Without it, choices are compressed, and compressed choices tend to destroy value. Then, consider optionality. Optionality is the ability to change course without incurring prohibitive cost. It is often invisible when things are going well and invaluable when they are not. High fixed commitments reduce optionality unless they are paired with redundancy elsewhere. This is why the same decision can be prudent for one person and risky for another. Finally, account for second-order effects. How does the structure influence behavior under stress? Does it encourage patience, experimentation, and long-term thinking, or does it incentivize short-term preservation? Systems shape incentives. Incentives shape behavior. Behavior compounds outcomes. None of this implies that progress requires minimal commitment or perpetual caution. It implies that decisions are context-dependent capital allocations, not moral tests. The same choice can increase risk in one configuration and reduce it in another. What matters is not the label attached to the decision, but the assumptions it embeds and the margins it leaves. Seen through this lens, not getting ahead is often a rational outcome of a system designed to be efficient rather than resilient. Effort has not failed, it has simply been applied within constraints that convert volatility into drag. The quieter takeaway is that progress is less about intensity and more about alignment between obligations and buffers, between ambition and adaptability, and between the world as expected and the world as it occasionally reveals itself to be.